In this week's video, we'll cover 3 simple and powerful long-term bullish concepts. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index. This is the S&P 500's 200-day moving average in red. We can see that for the most part, when the 200-day moving average rolled over in calendar year 2000, it told us that the probability of bad things happening had increased, and indeed bad things happened for a long period of time. And then when the 200-day moving average turned back up in calendar year 2003, it told us that the probability of good things happening was improving relative to the probability of bad things happening. And after the 200-day turned up, good things happened for a long period of time. It rolls over again, very bad things happen. It turns up here, good things happen for a long period of time. Turns back up here, very good things happen for a long period of time. And that brings us basically to the present day. We see a turn again in calendar year 2016, which once again tells us that the probability of good things happening, looking out several months or years, is now greater than the probability of bad things happening. The beauty of technical analysis and the beauty of charts and math is that we're looking at a set of facts. It's an indisputable fact that the long-term trend in the S&P 500 turned back up in calendar year 2016. The slope of this line, we can't debate that. We can see it, it's factual, and we can measure it. When we search for a possible rational explanation as to why the probability of good things happening has improved relative to the probability of bad things happening, or maybe more importantly, how is it possible that good things could happen from this point here for a very long period of time? Clients and regular viewers know that we use charts to monitor and adjust rather than anticipate and hope. This analysis is similar. We're not forecasting here. We have a hypothesis that we're going to cover based on the facts that we have in hand, a bullish long-term trend in the U.S. stock market. As we move forward, the charts and the facts in hand will allow us to continually test that hypothesis. If the hypothesis turns out to be correct, then we would expect this chart to have a favorable look over the next several years. Whether or not that happens is somewhat irrelevant because we'll take it day by day. The charts can also help us determine that the hypothesis is incorrect. So as a starting point for our conversation here today, this is what we have in front of us today. It's bullish. In the remainder of the video, we'll cover 3 possible answers to our question. How is it possible that good things could happen for a very long period of time? We've covered the first topic in detail in past videos, so we will not spend a lot of time on topic number 1, which is the long-term breakouts in the U.S. stock market. This is the NYSE composite. This is calendar year 1997. This is 2017 over here. For the most part, from 1997 through the present day, we stayed inside of this orange box. We're trying to break out of the box now, and we know the longer a market goes sideways, the bigger the move that we can expect to get, either up or down, after we get either a bullish breakout or bearish breakdown. Right now, based on the evidence that we have in front of us today, we still have a bullish breakout on this chart. When we originally covered this topic, end of January 2017, the NYSE composite closed at 11,313. On March 30th, it is higher. The breakout's holding. We're currently at 11,519. So we're in this area here in the present day. And in late February, we covered the long-term breakout in the value line geometric index. The longer a market goes sideways, the bigger the move that we can expect to get. And we know the longer these breakouts hold, the more meaningful they become. So this chart too will help us test our hypothesis. If this breakout fails, that would not support our hypothesis from a long period of time. However, we will not know whether this is a successful or failed breakout, possibly for several months. But as of February and as of the end of March, this is currently a successful breakout, leading us to the question, this is a technical factor. What are the fundamental factors that might drive a move in this direction for a long period of time? Which brings us to our second major factor. So weekly NYSE composite, this is calendar year 1980 on the left side of your screen, and the present day March of 2017 on the right side of your screen. And if we fast forward out to calendar year 1997 from 1980, we have a period where good things happen for a very long period of time. And if you know your market and economic history, we can make a rational argument that during this move from 1980 to 1997, the primary driver in the financial markets was the economy and fiscal policy, and a secondary driver, a still important driver, was central banks and monetary policy. And with Reagan and Thatcher in power in the early 80s, we had a shift away from centralized government power and a shift toward a more limited role of government and central planning. There's a reason this box ends inside of calendar year 1997. In 1998, there was a hedge fund that made some bad bets, and the Fed made the decision that long-term capital management was too big to fail or unwind in a disorderly manner. They did not want a rapid liquidation of long-term capital management's assets. Therefore, they engineered a de facto bailout where other private firms stepped in to buy their assets, allowing for a more orderly liquidation. And as we noted earlier, inside the green box, the primary driver was the economy, but the Fed's decision in 1998 to help wind down LTCM allowed for a shift at point A here in the second half of 1998, allowing us to make the argument that the shift said that central banks and monetary policy arguably became the primary driver of the financial markets. That doesn't mean that the economy and fiscal policy were irrelevant. It's just central banks moved up the food chain. And as we move forward, we'll see that something changed from point A forward. Instead of a strong secular trend and markets driven primarily by the economy, we shifted into more of a consolidation period, marked by global central banks that are much more involved in the day-to-day activities in the financial markets. The orderly wind down of long-term capital management occurs here. We rally into calendar year 2000, and then the bear market takes us all the way back, basically, and below these levels here. So we make no progress from point A to point A1. Central banks help engineer a rally and a recovery here, and then we rally into calendar year 2007 and enter a bear market. And once again, point A2 in 2009 takes us below the level of long-term capital management, giving us evidence of consolidation. Stocks are here. They're basically at the same level here, and they're basically at the same level here in calendar year 2009. These bullet points provide a quick review or some examples of where central banks became more of meddlers than innocent bystanders. We have long-term capital management. We go into the dot-com bust. We have the World Trade Center attacks. We have subprime loan problems. We get rate cuts, emergency lending, bailouts for Fannie and Freddie. The Fed helps with Lehman, Merrill, and AIG. We get to a point where we have a coordinated global rate cut, underscoring this shift. Inside the orange box, we have TARP, the bailouts of GM and Chrysler. The Fed helped money markets. They helped Citigroup. They started buying mortgage bonds, cut rates near zero. Followed that up with QE2, QE3, and we get over to the right side of the box here. We're getting to extremes where central banks are almost pushing on a rope, where we get to negative interest rates. And at one point, the Bank of Japan was even buying stocks. Reviewing some headlines from the right side of the box here will help remind us just how prevalent central banks had become in the day-to-day decisions that were being made in the global financial markets. January 2016, Reuters, Bank of Japan stuns markets with surprise move to negative interest rates. March of 2016, ECB, or the European Central Bank, pulls out all the stops, cuts rates, and expands quantitative easing. Bloomberg, May of 2016, Yellen doesn't rule out negative rates. In this area here again. And if there was ever an example of the extreme nature of the central bank's involvement in the financial markets, this was it. August 2016. The Bank of Japan cut right to the chase, and they just started buying stock-based ETFs. And it's important to note that during this period marked by central bank involvement, the stock market was never able to break above the highs from calendar year 2007 and hold it. We broke above it. This looks like a failed breakout. We come here, and this is starting to look like a failed breakout again. And with central banks in the pushing the rope territory, when you have negative interest rates and you're starting to buy stocks, you've basically run out of options. The markets were concerned that if this trend continued inside the box of bear market starts, we fall to the bottom of the box. Inside the box of bear market starts, we fall to the bottom of the box. Therefore, there were concerns technically and fundamentally with central banks running out of options and global growth remaining in that tepid range that we could once again revisit the bottom of the box. And if that happened, we would have moved all the way back to the levels, 1998 levels, where the Fed decided to have the orderly wind down of long-term capital management. Therefore, given all of these concerns here inside of the yellow box here, it's logical to surmise that something must have changed to break out of this long-term consolidation period, allowing markets to move higher. With central banks backed into a corner here, we had the Brexit referendum, and soon thereafter the US election. And instead of continuing the consolidation pattern where we move to the top of the box, see a bear market that might bring us to the bottom of the box, following these two events, stocks were able to complete what now appears to be, given the evidence that we have in hand in late March of 2017, a bullish breakout. We have now made a higher high above this consolidation period here. And as long as this holds, this is a bullish breakout from a long-term consolidation box. And just as we were able to make an argument about a shift here, where we went from the Reagan-Thatcher era, dominated by the economy and fiscal policy, to the long-term capital management era dominated by central banks, it's possible, based on the facts that we have in hand, that we're moving into the Trump Brexit era, where a shift is again taking place. We're shifting away from central banks being the primary driver of markets and back to the economy and fiscal policy being the primary driver, which would be similar to the early 1980s. And if that hypothesis turns out to be correct, and that's a mighty big if, we'll take it day by day, that means we could be moving back into a green box rather than a central bank-dominated orange box. A very significant difference between this period here and this period here in terms of market behavior. Notice the slope of this line here relative to the much more muted slope of this line here. Stocks make money inside of both boxes, but markets prefer to be driven primarily by the economy and fiscal policy. They get much more jittery when a small group of people known as central bankers become the primary drivers. Allowing us to shift back to our question, how is it possible that good things could happen for a long period of time based on the facts that we have in front of us today? The answer is we could be moving back to a more attractive slope like this rather than a muted slope like this. Thus, a quick review. Our first major factor is the technical breakouts from the long-term consolidation boxes. Our second factor is somewhat of a two-pronged factor. The first factor is the shift away from central banks being the primary driver and toward the economy. Once again, doesn't mean central banks would be irrelevant going forward. They just wouldn't be the primary driver of the markets as they were inside of the orange box. Before we dig a little deeper into major factor number 2, it's a good time to emphasize some key points. Key point number 1, remember we said something changed in 1998 and that we should remember point A in 1998. When we look at the broad, equally weighted value line geometric index, the concepts of the shift become much clearer. This is the same point A here in 1998. So we have the Reagan-Thatcher era here in the early 1990s. This is the slope of the broad market. Then the Fed moves to the forefront with the wind down, orderly wind down of long-term capital management. Look what happened after that. Stocks, for the most part, the broad market, make no progress from calendar year 1998 when the shift occurs to the present day in calendar year 2017. We can also make an argument that we have some similar shifts in the present day in terms of the role of government. This is Ronald Reagan. As government expands, liberty contracts. Under our approach, a fact-based approach, our personal opinions are basically irrelevant, and that includes our personal opinions about politics, where we have a similar shift in philosophy of a more limited role of government and contracting the size of government rather than expanding it in the present day under the Trump administration. Perceptions about the role of government and centralized planning are different in this period here relative to this longer-term period here dominated by central banks. And if the hypothesis is correct and we're shifting back toward an economy-driven marketplace, then we would expect that perceptions about the role of government would be having an impact on the markets going forward. In the present day, headlines paint a picture about a significant shift in perceptions. Homebuilder sentiment roars to 12-year high as regulations get rolled back, referencing the role of government. March 2017, optimism among U.S. CEOs shows biggest increase since 2009. Majority of executives say tax reform, biggest pro-growth issue. Once again, referencing the role of government and fiscal policy instead of monetary policy. Another example of a shift in economic optimism, March of 2017, CPA executives, economic optimism highest since 2004. March of 2017, the dramatic increase in positive sentiment and outlook among CFOs surveyed is one of the most pronounced in the 7-year history of the survey. CFOs expressed optimism, suggesting that CFOs are feeling quite bullish and are prepared to act on that sentiment. March 2017, Reuters headline, Asia's top companies are more optimistic than they've been in a long while. March of 2017, all signs point to a coming deal-making surge. Bloomberg, March 2017, U.S. consumer confidence unexpectedly surges to a 16-year high. January 2017, Bloomberg, U.S. Small Business Optimism Index surges by most since 1980. And anecdotally, when we had a similar surge in 1980, good things happened for a long period of time. Thus, a big part of our hypothesis and answer to the question, how is it possible that good things could happen for a long period of time, on the right side of our screen, just as we have hard evidence in hand in the present day of a shift in the stock market's long-term trend from unfavorable to favorable, from unfavorable to favorable, from unfavorable to favorable. We also have hard evidence in hand showing a significant shift about the perceptions of the role of government and economic policies. Via this Twitter account, percent of University of Michigan respondents providing unsolicited favorable comments on news heard about government policies. Here's the range between 1978 and early 2017, and here's a massive spike, an unprecedented spike going back to the data in 1978. If the hypothesis that good things could happen for a long period of time proved to be correct, we would expect two things. One, the headlines that we just reviewed should be reflected in the charts. And if good things are going to happen for a long period of time, we would expect to see strong and bullish trends on multiple time frames, not just the 200-day moving average. Thus, to help us address those two issues, we'll go back to our daily charts of the S&P 500. We've got the 30, the 50, the 100, the 150, 175, 200, 225, 250, all the way out to the 275-day moving average. This is late in calendar year 2000. We have that full-bore bearish look with the fastest moving average, the 30-day, on the bottom. After we could see this and measure it, really bad things happened, with the S&P 500 losing an additional 41%. Similar situation early in calendar year 2008. The 30-day blew the fastest moving averages on the bottom. We have that full-bore, low probability bearish look. After we could see it and measure it, really bad things happened, with the S&P 500 losing an additional 50%. Therefore, rather than having vulnerable looking charts and vulnerable facts in hand, if our hypothesis were true, we would expect to see strong and bullish trends on multiple time frames in the present day. How does the present day compare to these vulnerable looks that we just covered, using the exact same moving averages as of the close on Friday, March 31st, 2017? Instead of having a full-bore bearish look, we have a full-bore bullish look with blue, the fastest moving average, on top, and our chart is dated March 31st, 2017. Is it possible that the look of this chart morphs into something like this or this? Absolutely, positively, yes, but we don't anticipate that, and it hasn't happened yet. A logical rebuttal might be, but what about sentiment? Excessive positive sentiment can be bad for the stock market. Are investors getting ahead of themselves? From an anecdotal perspective, the answer is no, according to the latest American Association of Individual Investors sentiment survey. Somewhat unbelievably, the latest survey, week ending 3/29/2017, bearish sentiment is not only above its historical average, but well above its historical average, and bullish sentiment Are individual investors wildly bullish? Not relative to the historical average of 38%. We're well under it at 30%. We're all familiar with the expression, markets like to climb a wall of worry. We definitely have some pessimism and concern from individual investors. Why are these shifts about the role of government and the role of central banks and the role of government policy and a shift in sentiment? Why are all of these factors so important? The answer brings us to our third major bullish factor that also helps us answer the question, how is it possible that good things could happen for a long period of time? From the book Market Wizards, markets operate more on psychology than on fundamentals. We have a psychological shift in the early 1980s about the role of government and centralized planning. After that, good things happen for a long period of time. In the present day, we have a similar shift about the role of government and maybe more importantly, the role of fiscal rather than monetary policy. Before we close, I want to make it abundantly clear for clients. The long-term breakouts, the optimistic economic shift, and the hypothesis that psychology drives the financial markets, extremely important to understand the impact of this bullish hypothesis on our approach to the markets going forward. The hypothesis and the three key points will have absolutely zero impact on how we manage going forward, since we make decisions based on hard data and the facts that we have in hand and the observable evidence. If the hypothesis proves to be incorrect, then the look of this chart will change. That may happen, but it hasn't happened yet. Going forward, we'll continue to use these charts as a tool to monitor and adjust if needed, rather than anticipate and hope. And the only way that we can do that is if we head into next week and head into every week with that always important flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.